Okay, welcome back. I think we're going to start slightly lower, neither here nor there. But there's good news, and the good news came Friday evening. India's GDP, fourth quarter GDP, came in higher than expected, 7.4%. The full year GDP is coming in at 6.5% versus CNBC-TV18 poll of 6.3%. The stronger number has led the market to worry that the RBI may cut rates by only 50 basis points compared to 75 basis points is expected by the market. Well, there's always that. Latha is here with the fine print of the numbers. Latha, morning.
Morning. Well, first up, yes, the expectation for Q4 was 6.85. It came in at 7.4. Full year expectation 6.3, whereas it's come at 6.5. So all that's very good. But you really shouldn't be looking at GDP because there is a huge indirect taxes component, indirect taxes minus subsidies. So that distorts the picture. If you look at the GVA, that also is very good. So even if you, net out the indirect taxes, the expectation was 6.5% for the fourth quarter, and we've done 6.8. So that still looks like a very good number. And within that, the internals, agriculture, construction, all these things, items that have done well are also employment-heavy sectors. So exports again. So it looks like, a larger number of people benefited from the growth number as well. Capex, as you all pointed out, at 9.4% in Q4 is positive. But looking at all this as well, there are still some signs of weakness. See, consumption has grown only 6% in the fourth quarter and 6% in the full year. It's not even in pace with the overall GDP growth, which is why FMCG companies have been complaining that urban consumption is stagnating, and there is no reason to believe that, the Q4 numbers will change their mind. Again, private capex is under pressure. That big capex number is because government invested hugely in March. The March government capex number was so large that has pushed up the number. It's not a private capex effort. And as you go forward into FY26, there is tariff uncertainty, which will mean no CEO will really want to put money when you're not sure whether you will be able to export, how cheap will be the imports. So all that is a problem. Capex, again, could take a little bit of a hit because the fiscal spend is going to go down because the deficit has to come down. So if you keep all this, the FY26 picture is still subdued, which is why I have not got a single economist report who has upped the FY26 number because of the strong FY25 number. I'm just running the numbers for you. Look at that. Goldman Sachs 6.2, Kotak 6.2, ISEC PD 6.3, MK is only 6%, and SBI has a larger range of 6.3 to 6.5. But as you can see, all of them are expecting a softer FY26 compared to FY25, even with that surprise. So I think the Reserve Bank call is not over. Although the market on Friday pushed up yields, fearing that the end repo rate will not be 5.25 but 5.5, I think there are people who will still tell you that no, 5.25 is still possible.
And this Friday, at least 25 bips.
This Friday is 25. There's only one person in our vote, SBI, who said 50 for even this. Okay. But the majority is going with 25. And that, I think, is consensus.
Okay. All right. So let the rate cuts continue. I think that's the call. Thank you so much for that, Latha. Good to get that understanding of the GDP data.